Hey guys, going live here for the second episode of the Home Buyers Seminar or web series. Today we're going to talk about mortgage. In the first episode, we weighed if it was time to buy, if the time was right for you, and now you've taken that first step. You've said, yeah, it's time for me to buy. So now we're going to talk about mortgage. Most people know that a mortgage is simply a house payment. But a mortgage is made up of two sections, four parts total, sometimes five. The two sections is your mortgage and your escrow. The mortgage has two parts to it, and that is your principal and your interest. And that's your mortgage. Depending on the type of loan you have mortgage insurance or PMI. That would be an added small percentage to insure the mortgage. And certain loans require that. FHA, rural development, they all have like a PMI. The second half of the mortgage is the escrow. And escrow is just a fancy name for savings account. It is a non-interest bearing account that's attached to your mortgage. And in your mortgage payment, in your house payment, they will take your homeowner's insurance that you decide you want to use and your property taxes that will be due, and they collect that every month so that come August, September, October, depending on the county you live in, you don't get this bill for like $1,000 to $3,000 plus a bill for homeowner's insurance. Instead, each month when you make your payment, a portion of that mortgage is going into escrow so that when it comes time, these can be made on your behalf. So a mortgage is a house payment. It's in some areas they call it an instrument, but essentially it's a 60 to 80 page document that gets filed with the county that says we as the bank own the house, but the buyers own the rights to the house and the equity. With that mortgage, there are several types of mortgage. There is rural development, FHA, conventional, for which is like a bank in-house loan. Generally, you have 10 to 20% down. They do it on like a 20-year or a 30-year with 10 to 5-year arms, depending on what you want. Conventional loans are great if you have the down payment and if you plan on paying extra and trying to pay it off, because with those arms, when it says like a 20-year mortgage with a 10-year arm, that means, or a 5-year arm, that arm means in that 5 years, any of the principal that's not paid off will have to be refinanced to that particular mortgage interest rate for the next 5 or 10 years or however long your arm goes for. So conventional in-house loans are great. They're usually not a fixed rate loan. Keep that in mind. Some banks will do in-house fixed rate loans, but if they say it's an arm, keep in mind that at some point your interest could change. So your mortgage is made up of all those parts, and before you even start looking for a house or an area that you want to live in, you need to get with a real estate agent or contact a lender and get pre-qualified. It's my practice. I won't show properties unless a buyer's pre-qualified and then give me that letter. But that's my personal practice. Every agent's different. So when you pre-qualify for a mortgage, they're going to look at multiple things. They're going to look at your work history, your debt to income, your credit score, make sure you have no judgments, stuff like that. There is no charge to apply for a mortgage. And when it comes to a mortgage, when you come to that point that you're ready to apply and pre-qualify to get that mortgage, it's okay to shop around. It's okay to go to one mortgage company and apply, go to your bank and apply, to another mortgage company and apply, because generally, as long as you purchase within 120 days, all of those hits will become like half a point to a point. It won't be multiple hits, multiple points dropping your credit score, because the credit scoring institutions realize that you're trying to shop for the best mortgage. If you apply for a mortgage and you don't get a result that you want, contact your agent, contact me before you start applying at multiple places, because maybe, or speak to your lender, because maybe you're 30 days out, like you just need another credit score to hit, or you need to do something minor, and in 60 days they'll check it again. So if you get news the first time you apply, it's okay to talk to your agent. All of that stays classified, and the agent and the lender can work with you to help get you where you need to be, so that when they rerun it and they say, okay, now you're good to buy, you're ready to move forward. And just keep your agent in the loop, because they are there to help. And as agents, we see this every day. I've had people that have been told by one lender, you will never get a house. They came to me upset. We looked at their stuff. I called a lender, asked a few questions, and the lender said, if they do this, this, and this, tell them to come see me in 60 days. We did that, and lo and behold, 6 years later, they're living in their house. So, don't take the first lender as gospel. It's okay to shop around, but if you don't get positive information back from the lender, meet with your agent, contact me. Let's work through, let's sit down, close doors, or at your house, wherever you're comfortable, and let's work through page by page and see what's going on. So we've discussed the parts of a mortgage, your pre-qualification. Now keep in mind, things like Rocket Mortgage and these online, where it's not really a bank, it's like a quick, rapid mortgage company. They do what's called a soft hit, and they look at your credit score and they pre-qualify you instantly. Be very leery of these, because I've had some where it's a week before closing and they finally pull their debt to income and find out that they're not eligible for the loan, and the buyer spent all this money with appraisals and inspections to not be able to get a loan because their debt to income is at 25 and rural development requires 24. And those are just numbers I'm throwing out there. That's every loan's different. Something else that's offered is Illinois Department of Public Housing, IDPH. They do offer multiple grants that coincide with a mortgage. Some grants, after you make your payments religiously for 5 years and that grant's forgiven, it gets removed as a lien off the property. They have grants that stick with the property over its life, and when you sell the property, it's due to be paid back. They have probably 6 or 7 different types of grants available, and each one requires you to do something different. And one of them is take the first-time homebuyer course. Now you can do it online, and pretty much what I'm going over in this little web series is that course. You just can't get credit for it. You have to go through an actual course, get the certificates, like $75. And most lenders will wrap that into the loan and just give you a number. But we're going to go over bits and pieces of it over these web series over the next several weeks. So there are loans out there within the state of Illinois that allow you down payment assistance so that you can get FHA. Like maybe you qualify for FHA, but you don't have 5% down. If you go to IDPH, and I have links and websites and information, all you got to do is shoot me a message, email me. I can send you that through email. I can send you the link and all the information through Messenger. But there's multiple programs out there for down payment assistance. And even though it's COVID, they're still being offered. When it comes to, we talked about shopping for a loan. When it comes to that whole buy within 120 days and all of those dings on your credit will be considered shopping, and it becomes like half a point total for all of them, not 1 point each time. A mortgage is not like a car. When you go to a car dealership, you apply. That loan person is shooting your information out to like 300 places to see who can get you the best rate. A mortgage is not like that. When you apply with a mortgage, that application stays with that mortgage company. They do not send it out. They do not reach out to other companies to see if you can get better rates, because then they're undermining their business. So don't think if you apply at one mortgage company that you're applying to 50, because it's not like the car world. Now, when we were talking about mortgage in different parts, I said you had principal and interest as your mortgage as part one. Part two is the escrow, the non-interest bearing savings account that you pay into every month that covers your property taxes and your homeowners. So if you have a fixed rate 30-year mortgage, your principal, interest, and sometimes your mortgage insurance, your PMI, that will be fixed. That will never change in a 30-year fixed rate mortgage. But your escrow can increase or decrease based on rising cost of insurance, rising cost of property taxes, etc., so forth. When you're making those payments on your mortgage every month, if your taxes go up and it eats out more of your escrow than what you've been saving, you will get a slip in the mail that says, hey, you need to pay in $150 or your mortgage is going to go up $90 a month. And when you pay that $150 in, your mortgage is still going to go up a little bit. Then you know one of two things: that your property taxes went up or your insurance went up. And at that point, that is when you call and price insurance, dispute your property taxes, do whatever you need to so that in the following year, it doesn't go up again. That's what agents are for. I know a lot of my clients, when that happens, they'll say, this is it. I'll say, check your property taxes, check your homeowners. 90% of the time, if it's a big jump, it's homeowners insurance went up. They price, they get a new policy, close out their old one. They take the money that they get back from the unused old policy and send it right in the next month into their escrow. And then the following year, they get a check back from escrow because they overpaid. Sounds confusing. It's not. It makes sense when you're living in it, but that's why I'm here. Questions, comments, you can always ask. So that is mortgage in a nutshell and how it works. Just got a connection issue. If you have any questions, feel free to leave messages, send messages. I'm always here. Very passionate about real estate. I love this. That's why I decided to do these webinars. On Monday, I will upload this video onto my YouTube page. That way, as you want to watch them in succession, you can. And next week, we will be discussing the pre-qualification and looking for a home as the next step. The way the home course goes, after we get through to closing, then the second half of the home buyer course, it talks about, it's a very brief section, but it talks about things you need to do once you own your home to keep building equity in it. And that's exactly, I'm just doing these webinars step by step from the course that I took with one of my clients years ago, and just doing rough outlines. If you have any questions, contact me. You guys have a great weekend, and I will see you next week on my live video.